Alright, someone has asked me if I could do a screen share and go over a couple of the trades that I've taken over the past few days, and well, over yesterday and Friday. These are the results from yesterday, actually, not today. I haven't taken a trade today. I tried to get long right here, and my order was one tick below the low of this bar, but I obviously didn't get filled. It would have been a nice one, but that's trying to buy a bottom, and the only reason I would do that would be because of the area that we're at here. You see we've come down to the bottom lower median line of this median line here, and I'm using this low rather than this low. If you had this automated, it would be using this low, but I'm using this low, and you can see that was where I took the trade Friday. We came back to the lower trend line here, trend channel line, which I exited at, and then it came right back to the median line again, and now it's been coming down, and it's come down to the lower median line. So I was thinking about trying to take a long off of this and maybe getting back to this area, this green line right here, but like I said, I didn't get filled, and now it's too far away for me to try to put on a long trade here. I was almost putting it on right here, but not quite the look I was looking for. So anyway, let's go over a couple of these trades. Let's go over that trade that I showed you here on Friday, and this is really this area as well, right there. So we've kind of come up to the top of the trend line again, which is actually a trend line if I were to connect to the low rather than the lowest body of the bar. You can see we've kind of overshot this trend channel 1, 2, 3 times, and now we're coming back into it. So this is the massive short covering rally that we've seen. And let me show you what that looks like on the daily and the weekly. So this is the weekly chart. You can see we've had a climax here. It's a weak climax. It's a dark blue. Well, it's just a regular blue bar. And then it's obviously extreme relative volume with that diamond marking that, and then the high of that being marked by that green line that shoots off from the top. And then of course we have a climax here, which was touching both the upper and the lower 5-period Donchian channel. So we get the diamond above and below. So that started the big move down. Then we have the first really large short covering rally. So that's the first one. So chances are what's going to happen is we're going to come down and make a lower low, probably go down maybe below 40. I would say very high probability of this thing going below the low here, because this is the first short covering rally. And then here, this is the daily chart, and you can see momentum is waning as we're making these highs. So we've come up, we've tested this high. See, it's not really breaking higher than this high though, it's just kind of coming up and testing that area. Okay, so this low was pretty obvious when we have such waning momentum. See, it starts to wane here, we get divergence, then it wanes even more, and we get even more divergence. Kind of like a double divergence, if you will. Okay, so now we've put in the high with the buy-in climax, the short covering rally, and now it's ready to roll over. So now let's look at the trades. So this was the trade on Friday. It was $2,700, 3 contracts. So what I was doing was shorting the move back to, you see on this 54-minute chart, I had drawn my median line from this low as opposed to this low. This would be the obvious low, and a lot of people would be waiting for it to get back to the median line to exit their long from here, but I would have a target before that, and I wasn't expecting necessarily this to be the main high, but I was expecting this to be an an intermediate high from which we would come back to the bottom of the channel. So I was shorting that, holding for the bottom of the channel, and then that was it. I could have traded from there back up to it, but I didn't want to try to do that after I'd already made such a huge winning trade. It was 92 ticks. So that's where I was shorting from. It's actually the top of this channel as well, from low here to low here, intersecting these wicks. Okay, it came right to the top of that channel in the median line. So that's where I was looking to get short. and then hold down to the bottom of that white uptrend channel. So when we get up there, we're up at R2, resistance number 2 on the floor trader pivots. We've got strongly waning momentum, and then we have here, we have the climax churn bar. This is the 6-minute chart. Let's look at the 18-minute chart first. And this will kind of show you a little bit, not as far apart the volume divergence that I was looking at. So we have the kind of waning volume as we come up into this high. We get the spike high here as we're breaking above all these highs. We get the buy-in climax, and it kind of trickles sideways to up. And as you see a kind of pattern like that, that's usually an ending pattern. So we have a kind of an ending diagonal there. You see? It's a typical, a move into a reversal. So that's usually an ending pattern, ending diagonal, an Elliott wave, you would call it. And then here we have even waning relative density as well. So once we get up into this area here, I go ahead and short a couple of contracts on this bar. And then as we drift higher, we make the last final climax churn bar. I short one more at the high. So that is right here on the 6-minute. So we get the climax here, then we get a weak churn, and then a strong churn. Once I see that strong churn on waning volume, with the market losing momentum, I short 2 right there on that bar. And then I have one more to sell limit right here, and then I had one more above that, and then one more slightly above that with my stop, I think a total of 35 ticks away or something like that. Because the volatility was so high here, I think the 10-minute volatility, 10-minute ATR was over 35 ticks or something like that on this day. Because you have such massive moves. I mean, this is 51.76 up to 53.50. So that's a huge amount of movement in a short period of time. So your stop would have to be relative to that movement if you didn't want to get stopped out, and then you wanted to be able to hold through this larger move that was coming. I was expecting to see a kind of an ABC correction. That's what we got. We have the A down. We have the B back up, which is also an A, B, C, and then that final end of the B wave was a climax, so we go straight up, straight back down, and then we drift back up, and then come lower. And then the C wave is 138.2 of A, which is the most common distance for the C wave. It's 138.2, and then it's tied at 100 and 161.8, and then third would be 61.8, and then fourth would be 200%. At least that's what the study of one guy revealed across several different markets. So that's the typical kind of a move to the C wave. Now my target was right here at the median line, okay, which was also R1. So that was the first and safest target. Now when you run the median line back to this swing high, remember like I chose the previous swing high on the larger chart on the 54-minute, so I run it back to this one. That gives me a target of the lower median line down here, which is also the bottom of this uptrend channel. If you can see here from low to low, that gives me this low perfectly, right where the two lines intersect, which was also where the 138.2 intersected. So that was probably the better target, but I went ahead and took a safe target with 92 ticks. I'm fine with that. I missed the rest of the move, but that's okay. What was that, an extra 20 ticks I would have made? That's a lot. That would be $600, but nonetheless a great trade. The next trade that I took was not as great. I did kind of cheat on my rules a little bit. I was getting greedy. Let's go over that now. First, let me show you what the 2-minute chart looks like here. So this is where I shorted on the 2-minute, and this was the only trade of the day. If I get one good trade, then I'm done for the day. So this is that final climax churn bar to end the move. You see it with a diamond above it, obviously. Here's another diamond. So here you can see the volume divergence is not exactly divergence, because these bars are about the same size. You can see you have the climax here, and then we go sideways to chop, and then we break above this high for the final climax, and then I short right there, and then it rolls. Okay, and then we get the B wave. You can see we pull back to the VWAP. This is where I almost got out the first time. I was going to take one off here, but I said, no, this is probably just, you know, a B wave. Maybe it'll retrace back into this area, and I'll short one more if it barely breaks that high. But it didn't. It did just the normal, you know, 78.6 retracement, as you can see, 78.6, and then it came down to the negative 61.8, which was in line with the 138.2. So we would have a fib confluence zone there, which I don't need to go into. But then you have the climax into this high, marked that high with a diamond in real time as it's happening. So, I mean, that's, you know, what other indicator is going to tell you that? And then it rolls over and comes right down to the median line, which is where I exit. And then, like I said, the better target would have been at that fib confluence zone and the lower median line here. And then it pulls right back to that median line, so you know it's a good one. Then it breaks through and then comes right back to the upper median line. And when it breaks through, you get the churn bar. So as it breaks through, you get the overshoot, the overthrow. All of that buying is met with limit order selling. Not necessarily limit order, but it's met with selling, and then it rolls over. So that was the trade on Friday. Okay, so this next trade yesterday on Monday, the 16th, was a trade that really originated from the 6-minute chart and then initiated on the 2 minutes. So I should have had a much smaller target because it didn't originate from the higher time frame. And I got greedy and tried to hold it, thinking it would move further than it actually did. I did exit one right at the very high of this move, but then it turned and I tightened my stop, and then I got stopped out here, still with a profit on the last two, but the first contract I exited at the high where I should have exited the entire position. But let me go over that now. So let me kind of explain the rules that I had for this trade. So just looking at the 54-minute chart here, we had this high put in. We came back down to test this low, which is where my exit was the previous day, which was Friday. And then we get this move up, right? And then it retraces a little bit. So I'm kind of thinking, well, this next move will go back and it will probably test up into this bar, or maybe even this high. So I have a feeling, well, maybe it'll get up to that area. Well, it did get up to that area, but it didn't get up to that area until here. Okay, so I had this little A, B, or 1, 2 really. And then, well, I was really expecting an ABC as we've come down to ABC, then we got an ABC. Maybe this is all starting a big new move down, but we don't know that for sure yet. You can see it's rallying off of that lower median line right now, as I said. So I really missed that good long trade there. But anyway, so I'm looking for this retracement. I get in long, and I'm expecting to break this high. I take off one a little bit early because it looks like it's about to, you know, have a major reversal. So I took one off and then tighten the stop, and then it comes down and it stops me out. So that's it for the day. Okay, so this is kind of what I was looking at, but you can see there's no major area on the larger time frame that I'm trading from. It's just kind of out in space. It's really a 50% retracement, not quite a 50% retracement of this first move up. Let's just see exactly. Yeah, not quite 50, maybe 45. Okay, so that's what I was looking at, and then the area that I was trading off of was the 6-minute chart. So there always has to be an area that I'm trading off of. And here, maybe this looks like too many lines if you're not used to drawing lines, but this is really nothing. This is not too many lines. This is what you need to trade off of in order to have an idea of where the important areas are. Because the areas are always changing. It's not a function of, you know, necessarily previous pivots in line with those pivots, but kind of a function of angles and the way the market's moving in relation to slope and all of that, that the next pivot will be a function of. Right? That's why the next pivot is here, as opposed to even with this pivot or in the center of this trading range here. Okay? So what we have is I've drawn the trend channel from the high to the high. That gives us this high. Then it rolls over. What does it roll over as? All right, we've got 1, 2, 3, 4, 5. Then what happens? We get A, B, C. And where does C retrace to but 61.8 from this high to low? Not all the way down to this low, but to this low. All right, so what else is that? It comes down, doesn't quite make it to the bottom of the trend line, because what I've done here is I've made a parallel of this line, and then I'll connect that to the major pivots, not necessarily the lowest low like I've done here, but the next major pivot, which is right there. And we've come down to that, and look what happened when we came down to it. We made a churn bar right there. It's a weak churn bar because this is a holiday. And that was another reason for the market not being able to get through this high. All right, it is a holiday, obviously, President's Day. So the volume is waning, waning, waning. It gets well below 100%, which is normal. So we're down here at about 20%. 20% of the normal volume. But relative to the previous 10 bars, this is a churn bar. It's a weak churn bar. So I know that even though we have low volume, we're coming down into an area where that low volume is still being met with support. So support's coming in right there. I know that. So I go ahead and buy a few, right? And then I have one more. Let's look at the 2-minute chart. And I have one more sitting right here at this low. And then one more sitting at this low. And it came down and touched it, but it didn't get filled. So I was not fortunate enough to get filled, I guess. But then it turns. All right, what else is this? This is the VWAP, the volume weighted average price, the average of all the contracts traded at every price yesterday. I'm sorry, during the session. This blue dotted line is the average of all the contracts traded from the beginning of the session until now. So it's like a running average. All right, and then what we have, the CP, the PP, the central pivot, the midpoint of yesterday's high and low, and then the pivot point, which is yesterday's high plus low plus close divided by 3. So we've come down into this, you would call the value area, and I'm expecting a move out of that. So we get that, right? You can see here, this is where the volume's coming in. It's obvious. Climax churn bar gets down into this previous low here. What happens? It immediately gets pushed back up on increased buying. Obviously it's increased buying because it moves back up. Then we come back and we test this area. So we're testing this area now. It's obvious. So I buy a couple out of that area thinking we're just going to go because we've already tested it here. You see? So I just go ahead and buy a couple. Then it pulls back. I say, okay, I'll buy one here. I'll buy another one if it comes down to the low here and then this low here. So I would have up to 5, but I only ended up with 3. And then it moves up. This is where I almost exited the entire position. I should have exited the entire position right there. You got a climax and then a churn bar. It's climax churn and then a churn bar. I should have been out right there. But then it just retraces ever so slightly, and then it goes up, waning momentum, and then a weak churn bar, which is about 3 times the size of the previous bars. You can see 30%, previous bar is 8%, and then 9%, so well over 3 times the size of the previous bars. That's why just a little bit of difference in the volume may not look like much to you, but it's actually quite dramatic. And then we have what? Waning momentum into the high here. Momentum is not something you can trade by itself. Obviously you want to use it, with areas, right? It has to be in line with something else that you're looking at on the higher time frame, or on an area with the geometry or trend lines, channels, median lines, Fibonacci, whatever. So we put in this high on a weak churn bar, breaks above the previous high, but look what we have back here. You see that high from this churn bar? Now look on, this is the 2-minute chart, now look at it on the 6-minute chart. Marking that high because it is extremely high, 202%. So people are trading the early morning in Europe, but then the US market nobody's trading because it's President's Day. So it drifts back up into that area where all of the selling had been carried out in the European session. We get back, we test it, we get a climax into it here, and then we drift up and we test it one last time, which is also the top of another channel from way back from yesterday, from Friday. And then I exit one right at that high. I should have exited the whole entire position right there. That's where I failed to stick to my rules because I got greedy. So my stop was below this climax bar. My stop was right there. I almost got stopped out here, and then it goes back up, and I had another chance to exit, and like an idiot I didn't exit because I was thinking this is the one that's going to break above. And it didn't, because there was no volume. I mean, look at that. What an idiot that I would expect that it would break above this high on such weak volume. That's, you know, rarely do I ever trade a U.S. holiday. I don't know why I was trading anyhow, but at least it was a winning trade. I was able to, you know, even on these two contracts, I still made a little bit of a profit, but not even close to what I had on the trade. All right, so that was the trade yesterday, and you can see what happened after that. It came straight back down, didn't quite get stopped out there, then it goes back up, get another chance on another weak term bar. Should have been out again right there. You can see when it gets back into this area, it immediately gets pushed back down, and then it finally comes through and stops me out on a churn bar, climax churn. Comes back down, now it hits the value area again, and that's where it puts in the low. And then it turns up. Okay, but since then it made the high, as you can see on the 162-minute chart, made the high right here. So it's come back and it's tested this area where we hit this area, it gets pushed back down. We hit this area, it gets pushed back down. We hit this area again, drifts a little bit lower here, drifts back up, tests it finally on high relative volume. Doesn't look like it, but I've got the conditions built in there so it will identify it. It marks it with a dot. It happens in real time, intra bars, that bar is plotting, and then it rolls and we get the climax back down. But what has happened? Where are we at? We've come down to hit the lower median line. Now if you're watching this and look at what it's done, it's come right back to where I said it would come back to, the previous area where we had the most volume traded, which is marked by that diamond. So this is almost integrating a, I wouldn't say volume profile, but something similar where we are marking the very high bars where volume is traded and then running a line out, so we at least know where there will be some resistance or support at that level, and now it's kind of fading off of that level. So anyway, those are the two trades. Hopefully that gives you a kind of an idea of what I'm doing, the kind of analysis I'm doing. Everything is very, very focused, methodical. The trades that I take are for very specific reasons. I'm never jumping into the market. I know exactly what, you know, the area that I'm trading from and why, and I have multiple good reasons for entering the market where I do. If you don't have multiple good reasons for entering the market where you're entering, if your reasons are based on, you know, squiggly lines on your chart and moving averages and such, chances are you're at best a break-even trader. It's really when I started incorporating volume and trend channels that I was making the most headway with my trading. And the fact is that's what I started with, because when I first got into trading in Ecuador, I was learning all of the old, well, I essentially was paid to study these things, but I had to learn all of the original work that was done on technical analysis, so all of the old stuff, you know, before the advent of all of these fancy equations that we kind of form fit the market to, with you know, all of these different averages and momentum and stuff like that. Momentum is useful. I do use it because it does show me when price is slowing down into an area, and I love to see that slowdown if I'm going to trade a reversal. So I do want there to be a slowdown. If there's not a slowdown, then I won't trade it. Now that makes me miss those kind of spike moves, but those moves are much more, they're much riskier than the standard kind of reversal that I trade. But anyhow, what I was getting at is I had to learn all the old methods, such as, you know, I had to read the book by Edwards and McGee. It was like the one book I had to read for the Chartered Market Technician exam. It was the first book you had to read, which taught you all about trend lines and channels and stuff like that. And then after seeing that and reading that and drawing them out on the chart and seeing that this is pretty amazing that this stuff could even possibly work, I would think that would be random line stuff. But really it's not. And then I got into Wyckoff, into volume analysis, and Alan Andrews. And then I got into Gann and went down some rabbit holes there. But got back and started really focusing on market geometry and volume analysis. But then, like an idiot, I bought into a lot of these day trading type software programs where you buy the software, you join a room, they supposedly teach you how to trade. And I spent a few years doing that, and it really set me back tremendously because I started thinking that, well, you can just come up with some rules based on some technical indicators, and as long as you stick to those rules, you should be able to make money. Well, the fact is, when I test out all these different rules that all these different people come up with, and I actually back test them and take every single trade that that kind of a mechanical thought process would would take, and I mark those trades and I do the back test. Without fail, they're all negative. So you quickly learn that those types of mechanical systems just aren't going to make you any money. You really need to understand the way the market moves and why it's turning where it's turning, based on higher time frames, based on market geometry, based on volume, different patterns, stuff like that. Only then, if you're able to figure out, why the market's moving the way it's moving, why it's turning where it's turning, only then are you really able to capitalize on some of these moves and start to make money. At least that's the way it's been for me. And you can see now it's rolling over. So just in doing a simple video like this, I just, off the cuff do some analysis, and you see it unfold as I'm saying it. So the only way I'm able to do that is by understanding the way these pivots form, the way volume comes into the market. You have to kind of think like some of the big boys with heavy volume would be thinking if they were to see some stuff like this. The only way they're able to put on some of these large positions is if they had liquidity. So when it's coming down as fast as it's coming down like this, and then you see a bunch of volume come in and it closes off of the low, you get the high relative volume bar, you get the climax churn bar, you know that somebody's coming in and supporting that market there. That doesn't necessarily mean that it's going to turn there, but you know someone is coming in and supporting the market there. At least they're unloading their short position. So you know these things. It's evidenced by what you see on the chart. And then the market moves out of those areas, according to a certain kind of probability. I kind of went into much more detail than I expected I would, but hopefully that gives you a kind of an idea of why I took those trades and how I trade and how methodical everything is. It's not that I have super rigid rules, because honestly I don't believe that really rigid mechanical rules are ever going to help you learn how to trade or make money. I know that's what everybody wants. I know everybody wants an automated system, but you want to make money in the market, you really need to learn why the market moves the way that it does, and you're not going to do that until you put aside some of these concepts that you've been using, and you get back to price action, volume, which governs price action, and then the market geometry. So I'm always trading from areas to areas, all right? And then if I see something happen in between, then I usually get out like an idiot. I didn't get out on this last trade yesterday when I saw the obvious happening here, right here at this high. Should have definitely been out there, like I said, but that's me not sticking to my plan. So if I would have stuck to the plan, it would have been a lot larger winning trade than it was. Unfortunately, it was only 460. It should have been over, 20, whatever, over $2,000. But anyway, I'm now able to consistently make these trades, but only because of what I've learned and what I'm using here with the methods that I'm using. So hopefully this gives you a little bit better idea as to what I'm doing and what these tools enable you to do. All right, so with that, I'll leave you with it.